39% fear. I mean, this is really weird. So we're going to talk about this. My first guest says it's unlikely that this narrowness can continue long term. I'm going to bring in Main Street Asset Management CIO Aaron Gibbs. All right, Aaron, so again, this 39% here is really kind of problematic, kind of worrisome for a lot of folks. Let's talk about this, though. I can't get it to move, so we'll leave it there.
Yep.
You, though, say this setup not only can't last, but that it could actually be maybe a sign of a recession? Small caps getting hammered, narrowness of the big caps?
Right. So a lot of it is saying there's risk aversion. There's a lot of fear out there. We want to be in what a lot of investors view as the safety stocks, and not necessarily as much as the retail investor is also going into the household names, the names they know.
Right.
They're not going out into names that they're not so familiar with. It's not something that you buy every day or hear about every day. And so that lack of breadth is really concerning because we're just not seeing investors go all in into U.S. equities and the U.S. economy as a whole.
But they're all in on the leaders, right?
Right.
I mean, so they're not afraid to be in these names that are more expensive, and yet, everything else they're saying, no, I don't want to. It's not even not being in them, Aaron. These stocks are getting hammered. I have quality names that are getting hit for no reason other than they're taking money out maybe and just chasing a handful of names.
It's a really constrained sort of there is no alternative type of market where Europe is looking so bad. The elections are really scaring off investors, and particularly countries where banks are the majority of the economy, like Italy, Greece, Portugal, Spain. Those are the countries that are really taking a hard hit because those are the countries that could be hit the hardest by these new elections and going a little more into
So then what
direction.
are you suggesting then? Okay, skip Europe, particularly European banks.
That's off. Like,
what
not invest
what
in
if I
Europe.
own some of these mega cap names?
I would say, start looking at taking some money off the table, being ready to pivot. Now, this type of narrowness doesn't necessarily mean that we're going to have a down market. It has many times. It could just mean that we're going to see rotation where the market is a little more flat, slightly down, and what you'll see is a rotation out of these high growth names and into more value stocks and stocks that are sort of the unknowns, the ones that aren't in headlines every day.
Transition, though, because I keep thinking about Alan Greenspan. December 1996.
Right.
Irrational exuberance. The thought for about 3 days the market was down.
Right.
3 days, right? Then we got more irrational, more exuberant. So, do you just ride them until the wheels come off?
Yes, and that's a great point. Is you don't do this until the trends are actually broken. I'm saying the warning signs are there. Like there's flashing signs saying, hey, this might happen, but this might not happen for another 12 months. As we see these charts where we're looking at decade-long histories, it can run for another 12 months, 18 months. But be aware and be ready. And I would certainly say if you have big up days and you are overweight in Nvidia, Microsoft, Apple, this might be as good a time as any to take some cash off the table to be ready to take advantage.
So trim, but don't get completely out because no one knows when this may stop.
Exactly.
What if you have quality names that aren't moving? Quality stocks. I mean, you can see these are companies. Let's say they're taking market share in the industry. They've got margin improvement. They've got amazing execution, but the stock is down double digits. Do you hold on to it or do you bite the bullet?
I believe in holding on to them. I really do think that once we get out of this sort of obsession with the top 7 names.
Because a lot of people are coming on TV saying this is the first inning. Like this obsession that you're talking about, they're saying, hey, get on board. This is going to last another 5 to 7 years.
Ultimately, institutional investors still control about 80% of all stocks, or own 80% of all stocks. They're the ones that are going to make the bigger moves, as much as we like to talk about the social media meme stocks. And it really is about a lot of risk aversion on the institutional side because they're saying, hey, this is too expensive. I'm concerned about getting all in.
Right.
And so we're going to look for a little more bullishness and better signs from the economy as well.
So participate, but don't drink the Kool-Aid.
Yeah,
Okay.
don't drink the Kool-Aid.
All right. So